This short video will provide a brief overview of how to use the Affordable Housing Assessment Tool, or AHAT. The AHAT was developed through a series of research projects examining the funding and financing of affordable housing projects across Australia. The AHAT is designed to calculate the funding requirements and the impact of different policy interventions on the development of new social and affordable housing projects for various households in need. The tool is a housing needs-driven tool. This means that the first step is to define housing needs that ought to be met and then work out what funding is required to meet those needs. The AHAT can be used to evaluate housing at a project level or scaled up to a precinct level. So now I will briefly run through how to use this tool. The first page outlines the license use terms. You will just need to accept these before you can proceed. Once into the main tool, there are four main pages. Each you work through in a step at a time. All of these pages have been preloaded with a realistic project, and each of the numbers and each of the boxes can be amended to suit your own needs. The first page is where we define the housing needs that need to be met through the development of an affordable housing project. So in each row, we can define a proportion of the dwelling mix in an overall project that will go to specific household types. This table can be added to accommodate a wider variety of household types in need. The first part is to define the type of household, whether it's a single, no children, couple, so on and so forth. The key reason for doing this is that firstly, we can sense check against a dwelling type that we're going to accommodate this household in. And the second reason is this household size and composition component is used to estimate the Commonwealth Rent Assistance eligibility. The second part is to define a household income. Now we've pre-populated with some weekly household incomes that we can use. And this is used to determine the level of rents that can be charged to this household, keeping it at an affordable level. So we can go through and create our own bespoke matrix of households that we want to accommodate in this project and give a proportion of the overall project that we want to have dedicated to these types of households. Now we just have to make sure that the dwelling proportions tally to 100%, and it'll indicate at the bottom here. The final component of this table is to select the tenure. So if we select social housing, the rent setting is against the income of the households, so we don't charge them more than is affordable. When affordable rental is selected, the model will use a rent based on some proportion of the market rent for a particular kind of dwelling in the area that you're working within. And the final one that can be selected is what we're calling an affordable sale. Now this is equivalent to a shared equity type arrangement, but in this case the proportion of equity being purchased by the household is determined based on what they can afford to pay towards a mortgage. So once that's set, we can then adjust some of the parameters around the rents. The affordable rental rate we've put in here at 74.9% relative to market. Now that can be adjusted to whatever is required. The social rental rate is a proportion of income. So again, that can be adjusted to whatever is required. Finally, the affordable sale parameters can be set down here. So what is an expected mortgage interest rate? We can adjust accordingly. What kind of deposit might be required by that household? And what is the maximum amount of income they should be dedicating towards repaying that mortgage over what period of time, which is the final box there. Finally, the CRA payment rates can be adjusted as they change as they change each year. The current figures in here are what are current today at the time of recording, but again, these can be manually changed. For reference, all the up-to-date figures are available through the Services Australia website, and this table here replicates the table that you can find on the Services Australia website, so they should be fairly easy to update. If you're not sure, please leave as is, and these are current figures. So once we hit next, we establish the basic parameters of a project. So the first part is to define the capital city region that we are basing the project in. Now these are capital city regions, but if you are working in the wider South Australian context, for example, you select Adelaide, and you can apply a cost loading relative to Adelaide. This approach is being based on construction cost guides, the Rawlinson construction cost guides, such that the figures that we can draw from there are all based around different state averages and position the capital city as the base case. So if we are working in Sydney, for example, we select Sydney. Now, what is the kind of land area that we're going to develop? Put that in, the plot ratio. All of this is really just to establish an estimate, a rough estimate of the dwelling yield we might expect out of a site. If you're working across a precinct, you simply just increase the land area and adjust plot ratios and plot ratio efficiencies to get you to a realistic dwelling output. If there is a commercial component, we can adjust the overall share of the project towards a commercial component. For example, a mixed-use building with some retail on the ground floor, it may equate to 10% of the floor space, which we can punch in there. And then finally, the development type. And this links to the basic cost parameters of a project. And how many bays we're going to provide against each of across the whole project, and the type of bays. Again, this impacts the costings. The development context, is this going to be built across a number of development stages, and what's the overall time frame for the project, and how much does the land cost as an input. Or we can choose to use a residual valuation method to estimate the land value. Finally, some other broad parameters in terms of stamp duty rates, infrastructure contribution, development application fees, land tax. Now we can decide whether we're going to turn on and off these contributions, whether they're relevant to particular projects or relevant to status as a charitable organisation. Box C estimates some other funding and financing parameters. Is there equity being contributed towards the cost of the project? And if so, how much? What's the interest rates applicable across different phases, development, operation? Are there going to be cash reserves held, and would that earn interest? We can adjust that interest rate value here. And then some different indexation rates that we may wish to apply to different elements of the project. Box D estimates the operating costs. So the first three figures are proportions of the capital expenditure, the capital value of the projects, in terms of repair, planned maintenance, and then sinking fund values. There are some accounting for vacancy and bad debt, and then some general other costs that are applicable to each of the units. So these are based on a per dwelling basis for the final 4. Box E, F, estimate the construction costs against different typologies of dwellings, so whether they're detached, attached, low-rise, high-rise, some site work costs, and some commercial area costs. Now these are based on some current estimates out of the Rawlinson's Construction Cost Guide, but each of these values can be edited if you wish to input your own specific values into these different dwelling typologies. So these here will link to the type of dwelling construction that we've specified up above. So once this is all set, we move on to the next part of the tool, and this is establishing the market context for the dwellings. First up, the sale values and the rent values are based on the market context for where this project may be occurring. So here, these are manual input fields, so we can just adjust what we expect or what the market valuation is for a new 1-bed unit, for example, and what are the kind of rents that we might expect to charge for a new market-based unit in that location. And finally, some values against the market valuations for any commercial aspect of the project. And the final window that we get to is the basic output page. There are a few different elements here. The first provides a set of policy levers that we can start to adjust and some parameters around some of those policies. The final set are providing a lot of summary information about the projects. So for example, here we have a dwelling summary that tells us gives us the output in terms of the tenure mix against the different dwelling types that we specified. And down the bottom, it gives us an estimate of the retained value of any dwellings that weren't sold based on the market valuations for those against each of those property types. The tenure share table is a rough breakdown of dwellings against each of the tenures that are possible within the tool. The fourth layer gives us the cash flow year on year against each of the elements in the tool. So construction costs, capital costs, the different recurrent costs, whether it's repairs, operation, maintenance, so on. The revenues that we can generate against the social affordable rental dwellings, any interest we may accumulate on cash held, if there are market dwelling components, what rents will come via that, and so on. The capital revenue is in lieu of any sales that have occurred as part of the project, and any costs attached to making those sales, which gives us a final cash balance against all the revenues and cost inputs. So the final balance at the bottom here is the sum total of all of the items in each of the columns. Now this balance sheet can be downloaded to a CSV file or Excel file that enables you to take the cash flows against this project we've defined and use it for your own purpose. The final element here is a balance graph, which is graphing that final cash flow balance year on year. And importantly, this is where we can start to adjust some of the policy levers here. So for example, if we take land out of the equation, what is the impact on the overall finances of the project, and we can see it adjust in real time. If it's a purely social and affordable, no market component, in this example, we can see that we still are left with a significant deficit after 30 years. But if we sell some, then we see that we enter into a cash flow neutral territory after about year 13. And of course, for example, this market sale component can be adjusted and that the graph adjusts automatically. So there are a number of different levers we can switch on and off. Land is a contribution towards the overall project. If there are capital grants involved in the project, if the payment on the land is delayed for a number of years so that we could save on the financing costs, this can be explored through this lever. If there are special interest rates that apply that would differentiate against the market interest rate, we can specify these against the different phases of the project. If a planning bonus is involved, which will increase the property yield, then that can be explored with this lever. Are there any concessions against the stamp duties? Are there operating subsidies on the social and affordable dwellings that are retained? This can be turned on and off, and we can adjust the proportion that this is applicable to. This is it. There are various terminologies for this one, but it could be what is being referred to at the minute as an availability payment, but it's a cash contribution against the cash flow for each dwelling in that year. So we can define the parameters of that operating style subsidy in box B. So how much is the cash contribution per dwelling per year? For how many years will it be made available to the project? So is it only for 10 years or 25 years? Will it be paid annually or as an upfront lump sum? And will this cash contribution be indexed at all? This can all be adjusted here. Finally, box C creates a bespoke matrix of dwelling types for any market sale components. The dwelling type mix at the beginning is based on the kinds of households we wish to house, but when components of developments may be sold into the open market, there are likely going to be requirements, planning requirements for dwelling mix, and also market-based aspirations in terms of what can be sold. So this can be adjusted here at the end. So that box C links to the market sales percentage of the floor area. The market rental, we can also say, well, instead of selling, we're just going to retain a number of dwellings but lease them at market rents. That can be included as a policy intervention, as cross-subsidy. And the final lever here is if we delay the accumulation of money towards a sinking fund for a certain period of time to send that cash flow towards paying down the debt, so there's less debt to service over the longer period, what impact would that have on the cash flow of a project? So all of these can be turned on and off, and the graph will adjust in real time, which then can be exported from this download financial summary button here. So that brings us to the end of this project, and we hope you find it very useful. Thank you.